All right, it's a couple of minutes after 7 on June 2nd, 2013. This is Ken Long and John Gowing from Tortoise Capital Management. John's not from Tortoise Capital, but he keeps this up. He could be. One of the things that I've been striving to do with the chat room and the base camp and through various workshops is to try to create or encourage the development of a community of practice for traders that have been sort of educated in the same ideas of reward and risk that Dr. Tharp has led the way in developing. It's my continued belief that we learn best by teaching, and so I've tried to encourage folks to use the chat room to post their best work as a way to get honest and helpful feedback from the folks in the community, many of whom are here tonight, because I find that that's the best way I found to improve my own trading practice is to try to offer my ideas to others, and so that's sort of the basis of the chat room and some of the workshops we've had out here in Kansas City, and so it was a real treat for me to get John's note demonstrating how he had been working with the RLCO framework, but on a longer time frame. And this idea probably goes back a couple years to one of our Kansas City workshops, in which John started off looking at the frog system, which we use successfully intraday, looking at it over longer time frames to see if there was something there. And I think that probably got the ball rolling, and he's just to continue to add to that research. And I thought it was especially appropriate to invite him to share it with others because many of us are in that category where we don't necessarily want to be full-time traders each day, every day, all day. And we're looking either to supplement income or manage our own investments on those time horizons more effectively. And so the results that he's been working through look very promising to me, and he's done a fantastic job of presenting the material in an organized way, and he addresses a lot of the reward to risk issues that I think are important. And so I was just really happy when he said he'd be willing to share that with us on the Sunday night. So enough from me, and I'm going to mute my mic here, and I'll be monitoring the questions. So I want to just turn it over to John for as much time as he shall consume, as they would say in the Senate. And let him run with it, and just thank him up front from all of us for being willing to put his ideas out there and to share those ideas for the betterment of all of us. And so thanks a lot, good buddy, and the floor is now yours.
Okay, well, Ken, thank you, and also I'd like to thank everybody that's with us tonight that shows an interest in this because, excuse me, I agree with Ken that we share our ideas, we only get better. My contact information is on the first slide. I'll certainly entertain any and all questions either during the presentation or after the presentation or anytime following. And what I will do is I'll try to compile all the questions that we get this evening that can be answered and hang them up in the chat room. There were some questions regarding some longer-term activities on have we back-tested or would we consider back-testing some other scenarios. We'll certainly do that, but we won't be able to have those done certainly by tomorrow. Ken did a pretty good job of addressing the RELCO evolution / revolution that really did start in Kansas City a couple of years ago, and I'm going to apologize to a lot of folks, excuse me, that were looking for the specific RELCO criteria in the presentation. And in this presentation, RELCO is more of a framework or a lens, if you will, to look through. So some of the specifics that we expect to see when we're in the shorter periods, and especially in the chat room, are not necessarily here, and perhaps in my account I didn't spend enough time thinking about the specific languaging and how people would react to it. But This has been an evolutionary process. It did start in Kansas City, and we'll even make a few comments about that as we go along here. And as a result, some of the general comments. Again, this was born out of the Relco revolution, if you will, and it did come out of Kansas City as we traded the frog, and then we looked at different lenses to look through on how we might be more effective and on how we might manage workflow. I hope Ken doesn't mind me telling the story, but this is one of the workshops where he found out that he couldn't manage 10 futures contracts at the same time. But we had a lot of fun trying. But the rules that are developed here certainly are my rules. They work for me, and they're based on my beliefs. I have done a lot of day trading. Day trading is a tough business, and I manage more than just my own accounts. So I like to make most of my trading decisions when the market is closed, when you get time to sit down and scratch your head and kind of think about what you're going to be doing. And I also like those decisions to be pretty simple. The benefit of that certainly is that, you know, for the folks that that are still working and don't have a lot of time on their hands or have a very limited amount of time, certainly this system works very well and can be executed using buy stops and other conditional orders for exit and profit protection. And I assume that, you know, most of the folks that are trading here have the software that will do that. I put down here I tend to exit losing trades very quickly. I learned a lot of that from Ken. My philosophy is slightly different, and you'll see that in the back testing that we did here, you should expect the trade, or you could expect the trade to work. So if the trade isn't working, then there's no point in hanging around because you know it's supposed to work. Ken, on the other hand, will sometimes enter a trade and say, I don't expect the trade to work, and I'll get out as soon as my thesis is proved correct. The point there is that it's two ways to get to the same answer. It's just the way I do it is a little bit different. And finally, when we talk about the money management rules that we're going to go through, the rules are designed to make you scrutinize non-productive trades, and in some cases, actually, I could say they penalize you for holding trades that are not productive. And quite frankly, every trade that's not working does shorten the leash, and you'll find that when if the market's been down and turns around and starts to go back up, you want that leash to be a lot longer, so you'll work a lot harder to get out of the bad trades. So why Relco? And again, I'm going to continue to use the term Relco as the framework that we've all grown to respect, and that's with the standard Bollinger Band, one standard deviation Bollinger Bands with the regression line crossover lines on the 10 and 30 period. You see some other, on these particular charts, there's some other Warden applications that I just find valuable, volume and price, similar to VWAP, but not really necessary for the implementation of this particular system. Again, why is Relco? It's unambiguous in any time frame. I look at this trade and it looks pretty good from across the room. You can do this on a monthly, weekly chart. I suppose you could do it on an annual, monthly chart. I haven't looked at that yet. We're doing some work right now on the monthly, weekly scenario to see how well that would work in a longer time frame. We've also done some work on a shorter time frame, looking at it on daily charts and taking it down daily and hourly. One of the things there is you get a phenomenal number of trades. I think we ran that in the last day or two, and there were, if you just ran the S&P, it was 5,000 trade signals were generated so far this year, and that's an awful lot of trade signals. So this system will also let you be selective. So a little bit of background: the back testing I say we, it's myself and some of the other folks that I talk to, but primarily it's me. Use a product called Warden Stock Finder, and I think a lot of the folks in the room are using TC2000, which is also a great product. Stock Finder will let you run rudimentary back tests, and I call them the same way, same day test, just to see if maybe the idea warrants some further interest. And you see here we tested the S&P, the NAS, the Dow Jones, and the mid-cap and small caps. And I'm not going to read the chart to you, but the interesting thing is when we actually traded this forward, traded it using just the NASDAQ 100, the S&P 500, and the Russell 1000, and that provided more than enough trades. Interestingly enough, even in the actual test, the actual trading forward, the results were very, very close to the back test, and that I thought that was pretty interesting. And we also ran the back test on the universe of ETFs with a success, and we also ran it initially with no stops to say, if we ran this and stayed in the trade for 10 days and got out, what would the answer be? And the answer was that you'd be in a successful trade a little over 60% of the time. So what that said was, okay, now it's time to put a few trade management rules in here and see how well it works. Interestingly enough, we tried this with a frog system as well on a weekly and monthly basis, and found, quite frankly, that the frog was entirely too sensitive to the specific point of entry, where we found that in this particular framework, it's not as sensitive to the entry. And what happens is you have a stock that becomes eligible to trade, and you've actually got quite a bit of time to get into that trade. So these are the live results. I think everybody has looked at these, and quite frankly, pretty pleased with this. It's been a good ride here for the first 5 months of the year. Now, granted, we've had a pretty robust market for the first 5 months of the year as well. I think February, March were a little rough, but since then it's been only going in one direction. And I think there's probably a lot to be said for looking at the system and perhaps putting a moving average filter on it to say that I wouldn't trade the Russell 1000 unless the Russell 1000 was above the, I like the 110-day moving average, others like the 200. And I think that's probably going to be a pretty good filter. And I think you just really need to understand that, you know, as we get into the sideways quiet channel of a market, if it just kind of meanders, you're not going to make a lot of money with this. Doesn't mean the system isn't working. It just means that you're not going to make a lot of money with it during that particular period. Finally, you see commissions here are expressed as a percentage of R, and what I did is I normalized that as 1% of the average account balance for the trading period. I personally believe that's important because we all, as we grow up with DARPthink and some of the other things that are taught by Ken and by IITM, you realize you run trading as a business, and first thing you have to do in business is account for the cost. So there's a cost associated with trading in the sense of commissions. There's a cost associated with margin if you're trading on margin. There's also a cost associated with the various tools that you would use to go ahead and do your research and whatnot. And I think it's a valuable exercise to figure out what your costs are and factor that into your position sizing, so you know you have to know how much you need to make to break even. Excuse me. So what we do is we use the trade. Excuse me. We use the weekly charts to identify the trading candidates, and then we use the daily charts to enter the trade. The prices, when it closes above the standard deviation Bollinger Band on a weekly chart, the stock is eligible to trade. And I always enter on a positive day when the previous close of the daily chart is above the Bollinger Band top and the open is above the previous close. So, I mean, basically what you're saying is you're looking for a higher high. It doesn't have to be the first day. It can be any day where a higher high exists. Now, what I do is I use a risk-reward ratio of 3 to 1, and I base that on overhead resistance. And I'll take overhead resistance back for a period of about 2 years. So if I look at a weekly chart and I don't have 3 to 1 based on a weekly ATR between my entry point and the point of the resistance, I'll wait. And I'll just wait until it either breaks through that resistance or fails. And you get enough trades with this system where you don't have to feel like you're going to miss anything, because really you're not. What I have found is that you have more eligible trades than you can take based on your capital typically. So it's a matter of picking the best ones. So I like 3 to 1. Works for me, and certainly as you trade this, if you decide to do that, figure out whatever risk-reward ratio works for you. I get out of the trade if the stock goes below the upper Bollinger Band boundary on the weekly chart, or when the stop is hit, whichever comes first. Well, we've got some rules that are pretty elegant for the stops, and those are important, and we'll talk a lot about those because I think in many cases they're more important than the entries. So this is just an example using one of the actual trades. You'll see the weekly chart on one side, the daily on the other, and you can see the entry point where on the weekly chart where the stock has made the criteria. And I should point out that we don't wait till the end of the week. If it closes above the Bollinger Band anytime during the week, well, then the stock is eligible to trade. And you'll find that'll happen actually quite a bit. So here are the general rules. No trades are entered without available portfolio heat. And I'm going to talk about heat here in just a minute, but it's the amount of open risk that's available in the portfolio. No entries within 5 days of an earnings release, and exit any trade 5 days prior to an earnings release. I think earnings releases are toxic. I had one huge loss during this period. Huge is defined as 4R, and it had to do with just a lack of attention to detail. I looked over to check the earnings date, and I wrote down the date, but I didn't go up and look at the ticker, and the ticker was not the stock I was getting ready to trade. And I was rewarded for that mistake by it gapped down 2 days later and lost 4R on the gap. So earnings releases are toxic, enough said. Enter at the risk reward of 3 to 1. And I set a hard stop of 1 weekly ATR. And I like to use ATR as a stop because it creates a volatility adjustment for the trade. And again, you can read the exit rules there. I don't necessarily get out of very many trades crossing down through the Bollinger Band top. They come out more on the profit protection and trade management that we're going to discuss here in just a second. So during periods when I've got multiple candidates, what I like to do is I enter the trade with the highest positive ADX, and I try not to, I won't say try, I do not have more than 2 open positions that are correlated with the same major industry. You know, it's kind of interesting. You'll get a period where you'll go through the S&P 500 and you'll find all the retailers, for example, are going through the roof. And you say, gee, I don't know which one to trade. Well, you could write a rule into your system at that point that says, if I have all the retailers going through the roof, then there's no reason I couldn't take a trade, for example, in XRT, and take advantage of the entire sector. And finally, any trade that's after 5 trading days, if it's negative or profit is neutral and I less than 0.2 R, I get out, because there's no point in hanging around. And typically in this system you find that the trades become profitable in the first 2 or 3 days, and if they don't, they start to become candidates for dead money trades, and that's get out and use your money somewhere else. So portfolio heat that we discussed, I use a maximum portfolio heat of 12% of my total account value. And that recommendation comes out of Van's book on the Definitive Guide to Position Sizing. Based on the SQN of this system as it's traded, it would take more heat, but I'm comfortable with 12. It would take easily up to 15. It would take up to 20% if you wanted to go that high with a lot of leverage. And I'll talk about this in a minute. You can get that high if you want to trade options with this system, and it will work. But and I have done it. But be ready for some volatility that you probably don't even want to think about. Sometimes it's 7 to 8% of your total account value on a daily basis. But if anybody's interested in options trading, I can certainly talk to them separately about that and how that's done. On the allowable heat, this is a mechanism to turn things down when it's not going well and turn it up when it is. And what I do is I adjust the heat for negative positions, and I multiply the current number of negative positions, the open positions, times the current position size value, subtract that from the maximum portfolio heat, and that's all that's available to trade. So what you'll find is in periods where you've got several trades that are actually not working well, you don't have the available portfolio heat to trade, because you have to assume that all the trades that are negative are going to go to the full 1 hour loss. They typically never do, but what it really does is it acts as a governor for you, and it also makes you scrutinize the trades that aren't working, because you sit there and mentally you're doing the arithmetic. You're saying, well, if I get out of this trade, then I've got this much money left that I can trade as risk capital, and you'd much rather be in a winning trade than in a losing trade. Heat calculations, if I'm not going to be in the market that day, I make them prior to the open. If I'm going to be in the market that day, it's the heat calculations are based on the negative and positive positions during the day. And what happens there sometimes is you may have a gap down and you may have 2 or 3 or 4 negative positions, and all of a sudden you get the morning hook, the market takes off, now all of your positions are positive. Well, now you can trade again. So you just need to be ready for that contingency. For position sizing, we use 1%. That's pretty standard, I think, among the group. And that's based on core equity. And core equity is defined at the beginning of the month. And it's based on your discretion. But once you define it, the equity reference, it is the equity reference point for the rest of the month. It's no fair going to change the core equity so you can change your position size. If you do that, you're just fooling yourself, and it would be the same as not having any rules at all. What I do, though, is to say core equity may be adjusted up during the month if the account size increases by 15% total value or more. You can never adjust it down. The reason you adjust it up is that, as you'll see in a minute with market money, what can happen is if you don't adjust it up and you're doing really well, you may end up with a trade with market money that already exceeds the 3% rule, and we have a rule that says once you have 3% profit, once you have profit that totals 3% of your account value in any one position, then you have to reduce it, and I'll talk about that in a minute. But 15% is probably a pretty good number. You could even take it back down to 10 if you wanted to. It's a great problem to have, I assure you. Market money, I think everybody is pretty familiar with that term. The difference here is we use market money, positive or negative, and it's defined as any amount greater than core equity or less than core equity. So during periods of gain, obviously your position size grows because you're adding the percentage of market money. And I'm not going to read the chart. If anyone has a question on the math, I'll be certainly glad to go over it with them. But I think the important part of this is that we use negative market money as well. So if you drop below your core equity figure, your position size is automatically reduced. And it gets reduced pretty dramatically because sorry, I'm at a loss for words here. I was just trying to get a sense for, well, you can see here in the example that the position size gets reduced almost half of what the original position size was at core equity. It doesn't take long. And if the losses persist, the system will reduce the position size eventually to zero, and it forces a trading band of the loss figure of somewhere around 8 to 10% core equity. And that's something that we all really need to have is what is the no kidding loss figure during the month where I'm going to fold up shop and then just kind of sit back and try to figure out why this isn't working. Is it the system or is it me? Or is it something in between? But it's a fail-safe measure. That's what it's designed for, and it works pretty well.
Hey, John, this is Ken.
Yeah.
The reason is because the percentage, 10%, makes that once you get a large win or or large losses, that takes on a greater percentage of the overall investable number. So that does act as a governor, but it also allows you to scale after a period of good fortune pretty quickly. So drive on.
Yeah, you'd be surprised at how fast it does scale, and you'll see some rationale for that here in the trade management product protection. I always try to let the market take me out of the trade, and my exception is 3%, 3R, or 50%. And that exception is that if one position, if the profit on one position grows to 3% or more of the account value, if I reach 3R, or if one open position accounts for over 50% of the open profit, then I reduce it. So we never expose more than 1 R of risk based on the initial risk. So whatever R was going in, that's where R stays. The first stop is a hard stop. And what I do then is I change it to a trail when it hits 1/2 R profit. And that seems to work really, really well. So, and what will happen then is once you start changing hard stops to trailing stops, you're going to find your account heat starts to change pretty dramatically. And what that does, it actually forces you to sit down at the end of the day and figure out what your heat number actually is. When you add to a position, you add it only if 1 R is achieved, and then only in the amount that equals the original R. In other words, what you don't do is you don't factor in market money for an additional R. You stick with what the original R was. So let's see. So going down to the actual rules, 1/2 R is hard stop to a trailing stop, and that's based on the original R amount. At 1 R, continue to trade. Add if it's appropriate, and appropriate is good momentum, trade, or judgment, or as Van likes to call it, when the stock is efficient, when it's moving up in an efficient pattern, as opposed to something, say, like a foreign ETF, which has a tendency to be all over the map. When you go to 2 R, change the stop from a weekly ATR to 1.5 daily ATR. And that 2 R, again, is based on the initial R amount. When you get to 3 R, scale the position back to 1 R open profit with a weekly ATR trailing stop and start all over again. That may sound prohibitive, but it's not. And I think in this last iteration there were 3 or 4 instances where a trade went to 3R, reduced to 1R, went back to 3R, got reduced to 1R, and then got taken out. But there were some trades that were in the 6, 7, 7.5R range, and for accounting purposes, I count them as individual trades, but they're actually one trade. And you'll find that when you get back in, for example, if you go to 3R then go back to 1R, 1R is actually bigger because typically what's happened at that point is your account size has increased. And also the single position accounting for 50% of the entire open profits, if that happens, reduce that position to 1R, because what you'll find mentally is that you start to manage that position and you're not really paying as much attention as you should to the entire account. It's just human nature. You open it up and all of a sudden all you're looking at is that that one particular number. And that's a lesson learned for me. That happened to me, I think, the year before last in a silver trade, where all of a sudden the silver trade was 8 or 9% of my entire account balance. And believe me, the only trade I was looking at was the silver trade, and that ended up being detrimental. But that's the reason that rule is there. A mental nuance. I personally view money as a trading asset, and I look at wins and losses as an asset allocation issue. When trades aren't working, I get out fast just because it frees up assets to go do other things. And again, you know, the 1R is not a design goal. It's what is the maximum that I'm willing to lose. As Ken calls it, it's the ante. But the difference between this and a poker game is you get to take part of your ante back. I usually look for a reason to exit the negative trade and a reason to stay in it. And the reason is that with the trades back tested the way they have, and then as we trade forward, we're in a 65 to 70% win rate. That says the trade should work. So the first time it doesn't work, then it's time to get out. And again, to use Ken's axiom, you can always get back in. And will you get knocked out on pullback? Sure. And then all you do is you wait for it to take out the previous high, and it takes out the previous high, trade's still eligible, you're back in again. But in the meantime, you'll have been using the assets in more productive trades. And again, losses are part of the trading, but they're easy to deal with if you don't keep them around. If you're getting rid of trades in the you know, in the 1/2 R, 1/4 R, they are pretty easy to deal with. So the tools that were used: Warden Stock Finder was the initial backtesting system computations. Warden TC2000 for daily sorts and identification of trade candidates. And I know a lot of you guys and gals use Warden, so what I'll do is I'll put the exact I'll take screenshots of the conditions and how they were derived and put that in the presentation as well. Schwab Street Smart Pro for actual live trading. Personally like Street Smart Pro because you can manage the entire trade before you even put it on. You can include, with the initial order, you can include hard stops, trailing stops, and profit exits along with buy stops. So you can fully manage the trade prior to the trading day actually commencing. And then finally, as many of us do, I use XLQ for trade management and personal record keeping. So final thoughts. Entries in this system don't need to be precise to be effective. And again, this was much different than the frog system when we initially did that on a longer term basis. We found that the frog was very, very sensitive to the initial entrance. But this work was also supported by Van Tharp and Chuck LeBeau, where they did random entries into systems and then managed the trade and proved that they could be successful without without a specified entry criteria. I wouldn't suggest anybody do that, but I think you can see where, if you miss the first 2 days up, get in on the third day up. It just, as long as the stock is eligible, go ahead and take the trade. Again, the earnings release comment, they're toxic, and I won't say any more about that. It was a 4-hour hit. Exits are more important than entries, and I just believe that you don't make any money on the trade till you get out. So you need to preserve some of the money along the way. And I used to be I still am a trend follower, but I've changed my attitude that it's okay to take profits along the way as long as you stay in the trade. So that's what the 1R does. When you scale back from 3 to 1, you're still in the trade, but you're putting some money in the bank as well. This was a good time to be trading. I will go ahead and commit to doing back tests with moving average filters, and just let you guys know what it looks like that, during periods, for example, when the index is below a 110-day moving average. How should you be trading the system? The system, again, it works great with options, but the equity swings, as Dakota calls it, volatility, and believe me, that's exactly what it is. But if anybody wants information on how the system trades with options, send me an email, and I'd be glad to send you the specifics. There were some advantages of this being longer term. We're going to do some more back testing. I'll share that with the group. I'm a believer that you need to look at charts every day. It trains your inner voice. I was kidding Ken this morning that the one thing that he does better than anybody I think I've ever seen is that he can take what his right brain is doing and translate it into a left brain explanation. Sometimes I have trouble doing that, but Ken's one of the best there is. Trade efficiency was good, and the efficiency of the trades, and you can see how it was measured there. This was a methodology that was put forth by Chuck LeBeau. But in this particular iteration, we were getting about 40% of the trend. LeBeau offers that if you're getting 30 to 35, you're doing a good job. I think that in this particular system, in a bull market like we were in, you can get that much of the trend, and you're going to get it on the north end. I think when the market settles down a little bit, especially if it falls below its 100-day moving average, then there will be a significant interest in using the actual regression line crossover below the river, if you will, as it comes back up, to capture the trend on the front end. And we'll do some work in there for back testing, and again, let you know how well that works out. But I think that's going to be the answer to, here's how you trade it when it's above the 110, and here's how you trade it when it's below the 110, or whichever moving average y'all decide is important to you. So that's it. I'll post the actual trades in the chat room along with the answers to any questions that we have here. And Ken, am I still with you? Hello, Ken. Hello. Can anyone hear me?
Hey, John, this is me. Yeah, I got you. I couldn't find that stupid the unmute button,
okay.
So I look like a freaking monkey trying to fix a wristwatch. Yeah, here's
not as bad as me typing. Can you hear me?
Yeah, well, some folks asked, was this recorded? Yes, I'll get it produced and posted on a private YouTube channel for us all to reflect on. Here are some things. I'm gonna take the screen control back over. I'm gonna post the compiled questions from the SurveyMonkey And then if you would take a look at some of those and answer, comment on any of the ones that we can comment on now, and then we'll commit to answering later. And then meanwhile, I can go through my notes. So I'm going to take the thing back then. Let's see. So yeah, can you see that now, John?
Yes, I can.
Okay. Why don't you just graze through those, and then I'm going to go over some of my notes. The first one was being sensitive to the effect of a bull market on the targets that you were trading. We know that there's a strong correlation between most of the large caps and the market itself, and so that's always going to be an issue. One of the beauties, I think, of the RLCO is that it helps you identify very quickly what kind of condition the market is in. And when the slope of the Bollinger Band mean, i.e. when the river is flowing upwards, I believe that for trading in that time frame, you can say that you have a bullish market. With respect to the using the filter of the 110-day DMA, which works out to about a 5-month moving average, we know that longer term, when you're holding positions for a month, that those filters generally help you by not getting you whipsawed. That the big whipsaws tend to occur earlier among relative strength leaders, but then they get back to the mean and then they start to fail. So by waiting for price above the 5-month moving average, you're getting candidates that already have a history of pretty good performance and therefore less likely to kick you out. The other side of that, I would say, is that there is certainly profit available from a RLCO outside the river when the price is below that 110 or this 200-day or whatever you want to use. There's measured profit potential available from the RLCO back to the Bollinger Band mean. It's not as much of a runaway good news story. So you have to you still have to factor in. I think your ratio of 3 to 1 is actually a very good one. I think if you look at trade candidates that are below the 110 as you intend, but then look for a 3 to 1 back to the Bollinger Band mean, I think you're going to find some things that are going to be available to you. Remember that on what you're essentially doing here is harvesting the RLCO breakouts from the top of the river. And
exactly.
So you're already kind of tapping into the market's bias for good feelings. You're not trying to play like the middle of a Fibonacci retracement or back to the mean. So my sense, though, is that as long as you are strict on your 3 to 1 criteria and use the Bollinger Band mean or the regression line 90 as a reasonable price target, I think you're going to find that you won't get as many candidates, but there will be enough that your win rate is going to be actually pretty reasonable. Especially if you're using that ADX as filter, the plus DI, to qualify your targets, you're still tapping into shorter-term relative strength leaders from among many candidates. So those are my thoughts on that one. For those of you thinking about weekly ATR percentage, when I've studied this and compared it to daily ATR percentage, I find that ratio of weekly to daily is usually like 1 to 2 or 1 to 3. That depending on the nature of the stock or the ETF, that about anywhere from 2 daily ATRs equals a week or 3 daily ATRs equals a week, and that seems to be normal. On something like utilities, where you could actually have a relatively larger ATR percentage, they don't really vary much on a weekly basis. So you get some daily fluctuation, but little week-to-week change. That would put you somewhere down around 2 to 1. But if you got something like a tech that was in sort of a breakout phase over a quarter, you might see that the weekly ATR percentage is actually 3 daily ATRs. That's a good thing, because then you would find things that are tend to be more directional with their volatility. You can almost use that ratio as an indicator of longer-term directionality. New idea that just popped into my head, but which I've been trying to put words to. I like your idea of the 5-day failure to follow through is information. You're essentially trying to find the RS relative strength leaders on a swing term basis, and if they're not following through in 5 days, then you have evidence that there's failure to follow through, and then like a good inventory manager, you're cycling that money to another a better target. I would just point out that if you talked about 30 minutes, about 3 minutes of that was really looking at the specifics of the entries, and about 27 minutes talking about the importance of position sizing individual trades and then managing the herd, and I think that's, and then working on the exits, and I think that's absolutely correct. I like the idea of using the weekly Bollinger Band north shore of the river as the exit. Well, here's what I've found, that you have to exit not later than that on just about any RLCO system that I've played with. When price re-enters that river, either shortly before or shortly thereafter, you would find the RLCO happening anyway, and so that turns out to be a pretty good move to use that as a default trailing stop. Plus, what you've seen now is evidence of return to the mean, and there's no reason to wait for it to come any further back to get kicked out of that. I would just, here's the image that came into my mind. There are two genres of movies that I really like. I like the Old West, and I also like Japanese samurai films. And I've been watching reruns of Lonesome Dove lately, and I couldn't help but think about trading your portfolio and managing all your positions is really the same issue that a handful of cowboys have trying to manage a herd of 1,000 longhorns, trying to get them to market over 1,500 miles of trail, and that there are periods of absolute boredom when the herd is just moving along and munching grass and crossing the. Sometimes you got to cross the river, and then sometimes a streak of lightning will hit, or a thunder, or a gunshot, and then the herd will go from complacent to stampede just like that. And so it's the management of those special events in a systematic way that tells you whether or not you can actually get the herd to market. So the best thing that I can think of to help you get that mentality right, to think about a herd manager or a portfolio manager, is watching Lonesome Dove. I'm reminded also of Robert Gardner's advice. Hey, it's better to be outside wanting in than inside wanting out, and that has a lot to do, I think, to your point about if you do get kicked out, all it really has to do is take out the previous high, and you'll find that the original setup conditions are still in effect that would allow you to take that as a trade anyway. But what it does is instead of just chasing it, it still has to qualify on your 3-to-1, and it still has to be among the risk to reward ratio winners or high ADX winners. That's a very effective way to get back into something that was where getting you out was an anomaly. And then the final thing, just to reinforce the idea of the Bollinger Band slope, the slope of the river as a proxy for market condition, that looks back far enough. If you're looking at weekly charts, you're looking back at 30 weeks to establish the Bollinger Band, and really, if you're looking at, even if you look at just 10 bars or 20 bars, the slope of that river can change from down to sideways to up in a matter of 20 bars. And that really is 50 weeks or a full trading year. And as long as, in my view, as long as the last 10 weeks are up, the slope of the river will be up. And there's enough reason to believe in that as a swing trade, because the distance from big sell-offs back to the 200-day moving average is larger than the move from a 200-day moving average to all-time highs. So there's enough distance, in my view, between the bottom of the sell-off back to the 200-day moving average as there is on the upside. So that's why I think I would caution you on using the moving average filters exclusively, because I think we would end up missing half the trades. But that's an intuition that can be confirmed or denied through the use of evidence. But that's my sensation. And really, I find enough opportunities in pattern number one or play number one, which is RLCO at an extreme sell-off, back to the Bollinger Mad Mean, that there's enough opportunities there that I can get quick hits and be willing to take those. And then sometimes some of those grow to become, second leg up and third leg up, which is what I think this particular setup and rule set is addressing. But I think you spent the right amount of time talking about position sizing and portfolio management, and a calibrated way to allocate assets, which is where the professional attention should be spent. So those are my comments here. So if you've had a chance to take a look at any of those questions, go ahead, jump on them now, and we'll take this to the next step.
Yeah, I think and thank you for the critique, Ken. I think we answered the first one, which was basically, do you have to wait till the Friday close, or can you take the trade anytime? And that's, you take the trade anytime, or the trade becomes eligible as soon as it crosses out of the river, and it's eligible at that point. So once you get 3-to-1, go ahead and go for it. And that was the first couple of questions there. How would it test out using candles, daily candles instead of weekly, to identify candidates? I can tell you that just for the heck of it, I looked at what the daily would have been this year. There would have been 5,000 available trades this year from the 1st of January until now, and it would have been the system said it was a 75% win rate with about a 4-to-1 win-to-loss ratio. And again, that's taken every trade. So the thing you have to be careful of there is that, I don't think any of us can take 5,000 trades. So how do you go through and figure out which ones you're going to take and which ones you're not? Backtesting says you can take any one of them and it wouldn't matter. But the comment that Ken made about whipsaw is that if you do this on a daily basis, I believe you will get whipsawed. And I did trade it last year for a couple of months, and the whipsaw was just it was pretty significant. So anyway, that's why. Would it work on daily candles? Sure. Would you need to go down to a time frame to manage the trade? Maybe. I think what you're going to do is perhaps you're going to defeat the purpose of developing a system that you can trade outside of market hours, because if you're going to take your signals on a daily chart and then manage it off, say, an hourly chart or something of that nature, you're going to end up being in the market every day, albeit you won't take quite as many trades, but you will be in the market every day. Backtest results on bear or sideways markets, those are coming. My promise to the group to get those into the room. Scan formulas for TC2000, I will include all of those in the presentation. Also, would like to hear about approaches to screening for candidates. That's in the criteria for TC2000. It's pretty simple. It was any stock that closed above the Bollinger Band boundary for that particular day. That's what we screened on, and then we went back and looked and said, okay, do I have 3-to-1? If I have 3-to-1, it's a candidate. What is Relco Revolution? It's my play on words, but if you've been through this with a frog and going back to thinking about how do you visualize because Ken, if I remember right, Relco was born out of visualizing the frog and having more visual cues. And I remember terms like the wave and the panda and all the other iterations that we went through to finally come up with Relco. And it was just it was a complete evolution of what I'll call a lens and a methodology. And quite frankly, I discussed this with Ken earlier, and I'll share with the group. I trade about 9 different accounts with different strategies in each one. And what I've come to do now is I use the Relco lens for all of them. And I say the lens, and that's just looking at the trades on a daily basis. That's not necessarily, it's not the entry criteria or the exit criteria, but it is the lens to look at the trade through, and it's the lens that I use to develop the inner voice. I think we've touched on all the questions that came in on the survey, Ken, but I will go ahead and make sure that they get answered in the presentation in the room.
Yeah, I would. I think one of those questions asked me what my thoughts about screening for candidates. In my general practice, although I'm on a shorter, I think I'm on one time frame earlier or shorter than John is. I'm using the swing trade systems and swing trade strategies to find candidates that are more likely than their peers to make significant directional moves in short periods of time. So looking for things that are ready to pop and ought to pop in a particular direction. And so I think that's sort of the same thing John's doing with his strategies. If you're screening for things that have made weekly breakouts that close above the top of the Bollinger Band, then by definition, and then ranking those by the plus DI, you're essentially filtering the best relative strength leaders on that time frame. And the dogs are tending to concur with that. Mark has asked for a play-by-play of both a winning and a losing trade. In order to respect the time, I'm going to ask John if you could get a couple representative screenshots to post into the room. I think that would just show on the entry and then a typical exit, or on a good trade where you talked about scaling down based on outsized profits. That would be helpful.
Yeah, glad to do that.
Yeah, and that way we're not squirreling around with it right here. So let's post that in the chat room as well. I did want to just show, just as a point of reference. Let's see. Yeah, so this is let's see. Yeah, this just shows this happens to be 3-minute charts, but you'll find that this could be any time frame. What I have drawn on here are what I think of as standard plays in this RLCO framework. And so the first thing, this RLCO outside the river, I've shown that on the outside. It's in the floodplain. The RLCO happens. And we expect it to get to the Bollinger Band mean. For 2-to-1, we compute the far side of the river as the 2-to-1. And it turns out that if you plan to enter as the price ribbon enters the river, you've automatically got like a 2-to-1 reward to risk. In this particular example, it got to the far side of the floodplain. That's sort of a 3-to-1. And then from there it pulled back to the Bollinger Band mean. Well, you'll notice where my arrow is. That's an RLCO outside the river, and it pulled back to the Bollinger Band mean. It held support and then gets ready to take off. So play number 1, as I'm describing it, is the RLCO outside the river moving back to the mean. Play number 2 is that after a successful trade number 1, it finds support at the mean, doesn't fail further, and then starts to leave the river. And I think of that as play anywhere entering from where it held support to where it leaves the river. Any entry in there is play number 2. So resumption of the next upward trend. Where I think that what you've got is something like this third yellow circle, which is that you're waiting to see it close outside the river and then taking the next entry. So if you can see where my arrow is right there, taking the high as it breaks above the previous candle, which closed outside the river, that's where I think this is making its move. And what I want you to notice is that the slope of the Bollinger Band mean over that period of time went from down to sideways to up. And so whether or not this is above or below the 200 period moving average, in my view, that's a tradable moment based on the fact that you've got one good trade in hand, found support at a higher low, and then is breaking out to the next abnormal move outside the river, and that actually makes the river itself turn up. And because I have a belief that there's a tradable distance from there up to a 200-day moving average in a bear, you actually are justified in taking that trade. Now, it just so happens that this is almost a well-chosen example. Now you can see where your entry would have exited at the fourth by this fourth circle when it comes back to the north shore of the river, and then it would have been a re-entry above this yellow line, which allows you to get on board what turns out to be a great move. I'm showing this on 3-minute candles, but I will tell you, having looked at multiple time frames, the way to interpret these signals is the same whether you're looking at monthly, weekly, daily, hourly, 10-minute, 3-minute, 1-minute charts, that the method of interpreting them is exactly the same. And for your purposes, what you're doing is looking for obvious signs of support and resistance over an appropriate look-back period in order to calibrate your 3-to-1 to the upside. And so I think that's sound. So in my view, what you're really finding are those that are in this play number 3, which is breakout north of the river after a period of relative strength. And so that's the kind of candidates that I think you're catching. Any comments on that?
No, I think that's pretty accurate. You find, just, though there are an awful lot of these that occur during a consolidation period.
Yeah.
So there'll be a period of 10 days of consolidation, and then all of a sudden off it goes. So that's very much that second period that you have there. Yeah. Between.
My other view is. Yeah, my other view is that when you look at different kinds of market conditions, when the market itself is in that period of sideways quiet channel, that can be used as a market classification that's going to affect a lot of large cap candidates and correlated ETFs. That the breakout from SQC can be the most lucrative trade of all, especially in Forex. And so if you've got a sideways period of 10 to 15 bars and you have an SQC, you definitely want to be ready for the breakout. And then I think what you would, in your case, what you'd end up seeing is the first bar move out, closes above the river, and then taking the breakout of that candle is an automatic entry and a sound way to play that, because you're looking at second week momentum actually. And it could actually occur anywhere in that second week. It could have been the Monday, a Tuesday, whatever day of the breakout occurs, you end up getting it. I think that's a very sound way to do that. I just had a long conversation with Bill Brower, and I have been thinking hard about the 5 different plays that I've outlined here on this chart. I've been thinking about, and I'm able to give him pseudocode for what I mean by those 5 plays, and he thinks he can turn this the RLCO playbook into a TradeStation bundle that would dynamically scan from 1,000 symbols off your watch list that mixes Forex and currencies and equities, so that when things like SQC occur or the breakout, the weekly close above the river, that would filter. And then he's able to compute the, he already has the code to compute reward to risk ratios based on some other work I've done with him. So that looks to be very promising. That's my next programming task with him for TradeStation. So that looks pretty interesting. So I would invite you guys, if you have any additional questions that we haven't covered or weren't on the screen, please send an email to me, longke@yahoo.com, and then we'll try to get them all bundled into one FAQ, and then post that in the chat room with start to finish case study to show this in action. So I'd like to really appreciate the work John put into this and the time he took to share this with us. Just an example of a community of practice at work where if you're willing to share, good things will come back to you tenfold. And so I'm really grateful to John for doing this for us. A lot of good ideas on my worksheet of ideas to consider. And I think you've done a fantastic job of putting this into reward to risk frames of reference that I think will keep us from going off the deep end. So this will be excellent. What I'd like to do is take about a 1 minute break for you guys if you can still hang in there. I'm going to go through the weekend reports. I think there's about 10 to 15 minutes additional discussion on those. There's actually some interesting things to talk about. So I'll give you 1 minute to take a quick break, get a beverage, or whatever you need, and then I'm going to stop recording this one here, and then I'm going to, in order that it forms a complete movie, and then I will do a separate upload of the reading of the reports in the usual way, and hang both of these at Yahoo. So, thanks a lot, John. +1 to you, man. Just fantastic work, and hope to do more of these in the future, and we'll just keep going. So go ahead and take a 1 minute break, guys, and then I'll be ready to start here shortly.